Kia ora, and welcome to the CoreLogic Property Market Update for September 2020. It's now over a month since the re-emergence of COVID-19 in our community and the resulting social restrictions. This has given us plenty of time to assess its impact on the property market, and most of the evidence points to it being minimal. That's not to say it hasn't been taxing on people or businesses, of course, but the property market appears to be very well insulated from the current economic downturn. And while challenges still remain, the downside risks appear to be diminishing. The first thing we turned to when the latest restrictions were introduced were our early market indicators. For the upcoming supply of listings, that means the count of appraisals run by agents. And while the impact was immediate, it wasn't long lasting. Activity dropped by 19% initially, but has since recovered to be back to the same rate as Alert Level 1 in early August. The blip in mid-August will cause a delay to the seasonally typical lift in for sale listings in spring, especially in Auckland. And ultimately, this means supply will continue to be constrained. Couple this with demand for mortgages remaining firm, and you start to better understand why property values are also holding up as well as they are. Speaking of, this month we released the first version of the CoreLogic House Price Index. It's the same index we've run and managed for years, now released under our own brand. And focusing on the change in values over the last 3 months, we can see just how well prices have managed to hold up and even continue to grow in some areas. Let's not kid ourselves though, the momentum from earlier in the year has dissipated, but the economic downturn has not yet translated properly to the property market. And there are fair arguments made now asking whether it ever will. As it stands, the negative impact on values has been greater in the larger cities, with the house price index recording a 0.7% drop in the main centres, no change in the provinces, dragged down by Queenstown, and 1.3% growth in the more rural centres. The drop of 7.4% in Queenstown is not a surprise, with both short and long-term concerns for employment in the adventure capital of the world. Meanwhile, our smaller centres, especially those more reliant on agriculture than tourism, have seen values continue to grow. Affordability will also be playing its part here, with low mortgage rates improving serviceability and comparably lower average property values providing a reduced barrier to entry for buyers. The inaugural CoreLogic Housing Affordability Report details affordability through 4 measures across the entire country, and one of the clear recent trends has been the deterioration in affordability of the Dunedin market. Across 3 of the 4 measures, Dunedin has gone from the most affordable of the big 6 to the 3rd least affordable. Meanwhile, it was already second worst in the 4th measure, rental affordability. Strong recent property growth, which peaked at an annual rate of 21% earlier in the year, clearly playing its part in the student city. And this flags potential vulnerability for further weakness after already seeing values drop 1.3% since the end of May. With rental growth slowing and the immediate prospects of capital gain reducing, you'd be forgiven for thinking investor activity might reduce. But low returns and perhaps more uncertainty elsewhere mean that investors appear undeterred in the student city. With 2/3 of Q3 complete, mortgage investors have picked up 30% of sales, their highest share on record. No doubt helped by incredibly low mortgage interest rates and continued reassurance from the Reserve Bank that they will do whatever they can to protect jobs and incomes. Indeed, the Reserve Bank Governor, Adrian Orr, has admitted that rising asset prices are a direct consequence of their current loose monetary policy, but it's a necessary outcome of providing cash, confidence and stability to the economy. In terms of downside risks, which do still exist, the wage subsidies have now ended, so I suspect some businesses may have to face some harsh truths about their sustainability. Fingers crossed, we move to Alert Level 1 nationwide very soon. But even with that the case, the economy won't be back to full operation anytime soon, with borders remaining closed and caution still present. So unemployment will rise. And while most economists have rolled back their forecast closer to 8% from 10% plus, this could still mean less demand for property, especially rental property, as the young and transient employed in the hospitality industry find alternative accommodation. Meanwhile, a Trade Me Property survey revealed there's no real concern about the election for those that are either looking to buy or sell property. That's no real surprise, given the lack of any real housing policies from either major party. So far, we've really only heard about a further commitment to influence the supply side of the equation, mostly in the form of social housing. So there's not much for owners or would-be owners to worry about. Further ahead, We know we still have the mortgage deferrals to come to an end in 2021, but there's a lot of water to flow under the bridge before then. And given 2020's track record so far, I'm not ruling out another curveball from somewhere which could affect how the year plays out. For now, the bottom line is that ultra-low mortgage rates are the key influence on the market, and this is bolstering sales volumes and property values. Make sure your finger is always on the pulse by listening to our weekly property market podcast, available wherever you get your podcasts. And check out all our reports, including the House Price Index and Affordability report at CoreLogic.co.nz. Mā te wā.